Just this last Friday, on the 15th of January, JP Morgan released their earnings for Q4 2020 and full fiscal year 2020, and the results they produced were actually very good and surprised me. During the Q&A portion of the earnings call, there was also a somewhat heated conversation between Jamie Dimon and an analyst where Jamie Dimon said that JP Morgan should be scared shitless of some of the Fintech's competitors that they have in the market right now. All of this will be summarized within this video, and at the end of the video, I'll be summarizing my thoughts on JP Morgan stock and giving a rough valuation of the company as a whole. Welcome back to the channel, guys. My name is Adam, and on this channel I make weekly videos about investing and personal finance topics and monthly breakdowns of my own dividend portfolio, which you guys can see at the beginning of every month, see all the changes that I make throughout time, and see how I manage a portfolio. Now, to give a quick overview of JP Morgan and who they are, just to give some context to these earnings, they are the largest US bank, and they are led by one of the most legendary CEOs of all time, Jamie Dimon, who spoke on their earnings call with this quarter's results. Also, JP Morgan is currently my number one holding in my dividend-focused portfolio, so just so you guys are aware, I do have an interest in this stock, and I do like this company, so there could be a little bias throughout this video. Now in Q4 2020, JP Morgan reported net income of $12.1 billion, which equates to an earnings per share of about $3.79. Now this number is up 42% from Q4 2019. Their revenue is also up 3% year over year, when in Q4 they produced $30.2 billion in managed revenue. Overall, their loans are up 1% year over year, and deposits are up 35% year over year, in part due to the uncertainty brought by the COVID pandemic and some of the stimulus efforts taken by the government. The one thing that I think needs to be highlighted during this quarter is that their credit costs were negative $1.9 billion. Now what this means is that early on in the pandemic, they built a reserve for losses for their loans. And as time has gone on, they're realizing more and more that this estimation for loans was a little bit too aggressive, and the losses that they're going to experience are going to be less than what they previously anticipated. So, as they draw down or release this reserve, this actually shows up on their income statement as income. But this isn't actually income that they earned this quarter. This is just an adjustment for the risk that they see in their portfolio moving forward. And with Q4 results, we can now completely summarize their full fiscal 2020 year. Now in fiscal 2020, they produced net income of $27.4 billion, which equates to an EPS of $8.88 per share. This number is down 20% from 2019, mostly due to this building of this reserve for potential losses in the future. In terms of revenue, they produced $122.9 billion, which is up 4% from 2019. And as we previously mentioned, their credit costs were $17.5 billion, which are up 213% from 2019. Now throughout this year, even though they released some of the reserve in Q4, they still budgeted in a $12.2 billion reserve in preparation for losses basically deriving from the COVID pandemic. Now, if we assume this reserve hadn't been built, which isn't necessarily accurate, but what it does is it normalizes operations, net income is about $39 billion, which is up 8% over 2019 figures. Later in the video, when I do my rough value calculation for JP Morgan, I do talk about a little bit more about what this credit cost and what this reserve does to their valuation in my eyes, so make sure you stick around till after the earnings summary to see that. Jamie Dimon is known for a couple things within the investing sphere. One of those is what he calls the fortress balance sheet. Basically, he has an incredibly high conviction that the balance sheet in terms of investing and running a business is undervalued in the market. So he makes a specific effort to really maintain a super strong balance sheet for his company. And with that, in Q4, their balance sheet was incredibly strong, with a CET1 ratio of 13.1%. The CET1 ratio stands for Common Equity Tier 1, and what it does is it compares the equity that it has in the company to its assets that it holds in its company. For some context, banks are required by law to maintain a minimum CET1 ratio of 4.5%. And in the long term, JP Morgan has a target for its balance sheet of 12%. So right now at 13.1%, it's really, really good, and it shows the strength that they have in their company. Now, the reason this ratio is so high is because up until this point, they have not been able to buy back their own shares due to restrictions placed on these large banks. But they did reaffirm that they would continue to pay their dividend to their shareholders. And now that they've been allowed to repurchase their own shares, they have a stock repurchase plan in place that they will be carrying out over the next year or two. Now, as we mentioned before, Q4 net income was up over 30% from 2019 Q4. And this growth came from two main sources: corporate and investment banking and commercial banking. Corporate and investment banking profits were up 82% year over year. The reason that their corporate and investment banking profits were so high in Q4 is because there was a very strong M&A market, or mergers and acquisitions market, that drove up investment banking revenue, and their equity capital markets were also very, very strong for them in this quarter. And this segment includes IPOs, for example, which in the stock market have been doing incredibly well. And then on the commercial side of things, their commercial banking profits were up 115% year over year. This comes down to the huge release of their reserves, which adds $1.2 billion in profits to their Q4 earnings. The release of reserve is because the companies that they have in their portfolio are looking a lot less risky than they had a couple months ago. So if these companies continue to do well and the risk or the perceived risk that JP Morgan sees in these credits continues to go down, this release of reserves should continue over time, and the profit should be bolstered up by this over the next year. But if things do not turn out well, if these companies over time are perceived to be more risky than they are now, JP Morgan is going to build back up this reserve, which will hurt profitability in the future. Now, I don't necessarily see this happening because I think we're kind of coming out of this situation with the pandemic, and over time, JP Morgan is going to realize some of the losses that they had in this reserve. However, I don't know necessarily if they're going to realize all of it. So I think this is one thing that will help bolster profitability over the next year or two as things kind of shape out and their actual losses are recognized, and those that aren't recognized will be added back to the bottom line. Now in 2021, they projected a couple different things. They projected that net interest income, which is the spread between the cost to borrow the funds for JP Morgan and the cost to their customers for borrowing the funds. So the difference there is their net interest spread. And they projected this at $55.5 billion in 2021, which is up just a tiny bit from $55 billion in 2020. Now, JP Morgan is still seeing very good balance sheet growth, but they're just held back by the low interest rate environment that we're currently in. I believe that when interest rates rise again, JP Morgan's net interest income should grow very quickly because they're continuing to grow their business, and that interest spread will begin to grow as time moves on and we return to whatever you would consider a normal interest rate environment moving forward. On the expense side of things, expenses are also expected to rise, but this rise in investments is almost all due to investments that JP Morgan is making for their business. They're expanding their operations and building out support to continue to grow into new environments and to really solidify the markets that they're in right now. They're going to be investing in marketing. They're going to be investing in technology investments like data analytics, cybersecurity, and AI. And they're also going to be investing into CX Loyalty, which is a company that JP Morgan recently acquired. Now, my personal favorite part about listening to these conference calls is the Q&A session, because their remarks are not planned. These are just thoughts that come off the top of their head. Hopefully they're prepared, and hopefully they're accurate, but they didn't have time to feed the results through a filter, so you can get more honest and candid responses from the management team. And in this Q&A session, an analyst asked about the competition from fintech companies. And on this topic, Jamie had a lot to say. Jamie Dimon said that they expect to see, and I quote, very, very tough competition over the next 10 years. He also said that JP Morgan should be scared shitless of these new companies. Now, this may be new to me, but I don't necessarily hear these executives of these companies swearing on their conference calls that often. So when it does, it leaves an impact. And I think what this does is this is JP Morgan sending a message to his executives that this is something that we really need to take seriously. But JP Morgan didn't leave this on a negative note. He did say that I expect to win, so help me God. And what this really does is, as an investor, it's really good for me to hear this out of Jamie, because I would rather that JP Morgan overreacts to this threat of fintech than underreact. And it sounds like JP Morgan is reacting properly, and they're ready to put up a massive fight to these new entrants into their market. So what does this earnings call really give to investors? The numbers posted this quarter were very strong, and the outlook given by JP Morgan looks promising. Now, we can't necessarily use this quarter's net income as a benchmark moving forward because of those credit costs that we talked about throughout this video. But they are taking the right steps by investing in technology and expansion into new markets. They're taking the threat of fintech companies seriously, which I think is a very good idea for them. And they're maintaining that fortress balance sheet that JP Morgan is famous for. So, moving forward, I like this company. But as an investor, you kind of have to do a little bit of work with the numbers to make sure that the valuation makes sense. So what I did is a very rough calculation of the value of the company. And believe me, this is not what I believe to be the actual intrinsic value of the company. This is just a back of the paper napkin calculation, so you guys can see my thought process of how I'm thinking about these credit losses specifically in the last year. So what I did is I took 2020 fiscal results, and what I did is I tried to normalize these to what I would expect to see in a year without the increased losses that they had this year. What this means is that they have a net income on a normalized basis of about $38 billion. Now, if we take that net income and we apply the average PE that this stock was trading at going into this pandemic of about 13, that gives them a $497 billion market cap. Now, if we take that $497 billion and we subtract out the reserve that they have on their balance sheet right now, that gives a rough valuation to the company of about $485 billion. Now, what this means on a per share basis is about $159 stock. And with JP Morgan currently trading at under $140 per share, I think that there is still a significant amount of upside left in this stock if you wanted to buy in right now. In general, I think that this Q4 report was very, very good. And it's nice to see that those reserves are being released with the company. That's a very good sign moving forward. JP Morgan Chase is still my number one position in my portfolio. And moving forward, I still am very excited to hold them in my portfolio because I believe they're a very safe stock, they're a very strong company, and I think they do a lot of good for the world. If you guys want to see how that portfolio has grown over time and the decisions that I make while investing in that portfolio, I do have a separate playlist on my channel of all my portfolio updates to date. Please like and subscribe to the channel for more content. And if you guys are interested, sign up for M1 Finance with the link in the description below to get a free $30 when you fund $100 into your account, which is an automatic, completely risk-free 30% return on your money. So you might as well do that. Thank you guys for watching, and I will see you guys in the next video.